Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and any questions you might have. Also, the outlook for next year, what to expect the first quarter of 2023. Happy New Year, everyone. Best wishes. Today is the last trading session of the year, so see you guys on Tuesday of next year. So happy New Year, best wishes, happiness, health, and peace. For those of you who are new, welcome. This is my brief bio. You can see here, I was Executive Vice President and Head of Technology at Options Express from its inception through 2007. Started Tradespoon in 2012. It's been 10 years, 10-year anniversary, so a decade. So I want to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing that for over 15 years, mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures are very important. Please read them. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, before we jump into trading plan, let's talk about next year. Again, future rehearsal exercises are very important. Every money managers, every wealth management companies right now publishing their projections for the next year, right? What to expect next year, right? 2024, right? So let's try. Well, first let's try 3 months, right? It's end of the year. A lot of things can happen, right? We do our projections. You try to forecast where are we gonna be positive returns, negative returns, how much negative returns, how much positive returns, what kind of drawdowns we're gonna have for the year. But as data arrives, you have to adjust, right? So by the end of 2024, that's a relatively difficult task, you know. And basically, it could be high, it could be low. It's more of a flip of a coin, depends on your, it will depend on data, right? You can try to predict how long will inflation stay elevated. You can try to predict when the Fed will pivot, and that will ultimately drive where the market ends. But it's, as of right now, it's hard to predict when the Fed will pivot. Is this going to be in February meeting, June meeting, or is it going to be in the end of December meeting of 24? Very hard to predict. We have relatively enough information for at least first 6 months. So I would say first 6 months. Let's try to predict, but for June, right? And everybody's trying to kind of figure out. I think there's 3 scenarios, right? One scenario, right, between now and June, right? We're talking about between now and June. One scenario, we break the 52-week low, which is around 350, right? So scenario 1, we are trading below 350. Scenario 2, we're stuck in the range, right? A lot of people basically saying next year, at least first 6 months, we're going to trade in the range, right? And the range is somewhere between this recent high, which was around 410, right? 410. Right. So worst case scenario will retest the lows, best case scenario will retest the recent highs. But again, we're gonna do something like this. Right? Scenario number 2, right? Scenario number 1, eventually we'll maybe jump to 380, 390, right? Oh, sorry, it's here. So doing like this. Right, and then break 350. Scenario 2, you're trading in the range. Scenario 3, Fed pivots. Let's say February, they're going to say that we're going to pause, and then April, they're going to say, inflation is under control, and we're going to start lowering interest rates, and then we end up somewhere above this level 3. Right, 430 to 410 or something along those lines. So to me, those are the possible three scenarios. Some people think we're going to trade in the range. Some people are going to think we're going to break the lows in the next 6 months. Some people say, no, we're going to make either new highs or at least get closer to 52-week high or recent highs. So those are the scenarios number 1, 2, and 3. I encourage you to think about it because the answers will depend. Where do you think market is going to be, right? If you think we're going to break the lows, right, and maybe trade at 320, right? Maybe at 320, maybe 300. You don't really know. Then the answer is, at this point, you probably just want to be either market neutral or slightly bearish, right? And it's too early to get aggressively bullish, right? You probably just want to hedge because we're in the middle of the range, 380. If you think we're going to reach 350 or 320, you probably want to be bearish going into the next year. If you set 2, well, it's a flip of a coin, right? You're at 50% range. You also want to be market neutral, right? But at 350, maybe you're going to start buying aggressively. At 410, you're going to sell aggressively, right? Because you know that the market is trading in the range. And the third is, if you think we're scenario number 3, then at 380 probably makes sense to start buying aggressively, right? You still don't want to be buying on the margin, but your cash position, if now you're at 50% cash, and you think scenario 3, maybe you should be only 30% in cash or 20% in cash, and to start deploying this cash into the next year and buy equities. So you have scenario 1, 2, and 3. Close your eyes. Make these future rehearsal exercises as vivid as possible, right? And I encourage you to do this, whether it's based on your type of trading, what you're comfortable trading, right? If you're day trading, same exercise happens. You project where are we going to close today. We're going to close at where's spiders? Not here, but let's say QQQ. Is it going to be between 260 to 70? Is it going to be lower than 260? Is it going to be higher than 270? And same thing. And you project based on your projection, then at different levels how aggressively you should be buying or selling. All right, so pause for a second. 1, 2, or 3. Let's answer that question. I'm going to look for answers. Good day, Faye. Ian, good. Sent video about market. Will you talk about it today? Yes, Faye. Solid sound. Okay, so sound should be good. Ian, let me know if sound is still bad. All right, so we have 2, 2, 2. Okay. Anyone else? All right, so we have few people said 2. Anybody thinks 1 or 3? Everybody said 2. Okay, interesting. No, I'll give you a little bit more time. Dan, Faye, 2, 2. Everybody said 2. Okay. All my bears are probably already celebrating New Year and taking a break. Okay, looks like everybody said 2. Everybody said 2. I'm going to be a little more bearish. I'm going to say 1, right? I think between now and May, we're going to be at 1, right? We're going to be at 1. Maybe, I think this is more popular opinion, right? More popular. Maybe half of the people think it's 2, half the people think 1. Very few people think 3. So it is between 2 and 1. Today, everybody said 1, 2. Okay. So first 6 months is 2. Everybody said 2, basically retesting the lows. The reason why I have a few reasons why I think the current lows will not hold. One is Apple, right? Apple is part of most of the liquid ETFs, right? Consumer discretionary, technology, QQQ, spiders, XLK. I think it's even XLY. So, and if you look at the weekly chart for Apple, you can see that this week it briefly traded below, and it's actually trading even now below the June low, right? So it continues to make 50 new lows this week, and right now it's actually trading below this 129 level. So if Apple is trading below this level already, which is earlier than I anticipated, and you do see this downtrend, Apple is, I don't know, a very large percentage of QQQ, very large percentage of spiders, then most likely it's going lower, right? There's really no support here. So spiders, the next level, QQ, Apple next level is 118, right? And one bad earnings, right? We are heading into the earnings season, whether it's going to be either Q4 is going to be worse than expected because Apple already pre-announced, that they have issues in China with demand, and in the United States with demand on iPhones. They had to close because of the COVID zero policy, and jump in COVID cases in China. They had to shut down several times their factories or don't have enough staff. But I think that will be reflected in the Q4 numbers already, similar to Tesla or Amazon for that matter. So you can see these mega cap technology like Apple, Amazon price pattern looks even worse, right? It's already trading below pandemic low, right? It made new lows since the pandemic low, and the next level of support is 70, right? So Amazon most likely also will drop below that level. Then you have, well, Tesla is kind of in free fall, right? There's really no support, but similar, probably is gravitating toward pre-pandemic high around 75 level. So for that reason, right, then ARK Innovation is trading. For that reason, I think market is vulnerable for any negative news, right? Especially a revision of the earnings, right? Right now, the most analysts are still expecting single-digit growth, right? Single-digit growth is in most of the companies. We already see companies like Tesla most likely not going to have upper single-digit growth, right? They might actually be, selling less cars next year. So ARK Innovation already below the pre-pandemic low, right? Makes new lows. So that's one reason, right? The mega cap technology, they haven't sold off enough, right? And same thing with Microsoft. I mean, yes, they are trading at low PE, historically low PE, right? Microsoft is trading at price to earnings 25. Apple is trading price to earnings 21, right? It's not the lowest. We've seen the, PE lower for Apple, right? So, it's obviously a lot better than when it was at 40 or at 30, right? So 20, but it's not the, 2019 it was 12, right? That's one reason, right? So the mega cap technology stocks, they're very vulnerable. They're sitting in the key support levels already. If they break through these levels of support, then path of least resistance is lower, right? And QQQ, right? QQQ in general, which is, I think, what is it, 20% or 30% of S&P, this technology is already retesting the lows, right? So the QQQs are basically retesting 52-week low, just like Apple. And the next level of support is basically pre-pandemic high, around 240. So it's a 10% drop in QQQ or more, right? So that will push spiders below. If QQQ drops 10%, then spiders will probably also drop at least 10%. So that's one reason. The other reason is value stocks, right? Value stocks are overbought. The VTV, if you look at VTV, it's basically neutral for the, actually, I think flat for this year, right? January 3rd. Well, slightly lower. I think it was 145, but for all practical purposes, it's at November levels, right? November of 21 level. And it's extremely overbought, right? With the idea that you can, a lot of people are parking their money in value stocks that pay dividend, whether it's banks, JP Morgan, Morgan Stanley, Goldman Sachs, or if it's energy, Chevron, Halliburton. ConocoPhillips, or industrials, right? Deere and Caterpillar. But if the global economy is contracting and we're in recession, then Deere, Caterpillar, JP Morgan, they will start making less money, right? The rate of defaults should increase with elevated interest rate. So that's the second reason, right? It's elevated. I think value stocks will retest the lows, right? Which was pre-pandemic high, right? Value stocks already retested pre-pandemic high. Technology hasn't reached that level. So I think in the next 6 months, technology will reach the pre-pandemic lows, and at least value stocks will retest the pre-pandemic high level, right? Which is a very important support level. The next reason is VIX, right? VIX is low, 21 level, so complacency. It's a historical average level of VIX is 20 meaning that just average, right? But with all the uncertainty in the market and all the unknowns in the market, that seems to be extremely low, right? So everyone is not hedged, even though I think someone did say, sentiment is all-time low also, right? Everybody is bearish, and it could be a contrarian signal. Very often it is a contrarian signal when everybody is bearish and everybody expects kind of well-advertised recession, right? Everybody, you turn on TV, everybody talks about recession. It's well-advertised, but then, why is VIX not at 40, right? If it's so well-advertised, why is nobody hedging? So when people are not hedging their portfolio, not hedging their position, any negative news and market is prone for sell-off, right? Very quick jump to 35 or 40. So that's another reason is VIX, dollar, right? This next reason is dollar is extremely, made a huge run in 21 and 22, right? From 90 all the way to 114, 25, 30% rise in dollar. It did give up, almost half of its gains. It gave up almost half of its gains, but I think it's overdone, and I think there is still one more leg up in the dollar, right? Still one more leg up in the dollar. I'm gonna have this ABC pattern: A, large retracement B, and then I think C is coming. Right? And the final reason, probably one of the most important reason, you have this yield inversion that usually indicates recession. Right now it's 13 plus 43, it's 56 points. I think it was as high as 80 points. And yield inversion, 4-year, 2-year yield paying 4.4%. That is not a good environment for equity markets, right? Historically, from finance courses, we know that elevated interest rate environment is not good for companies' earnings. So for that reason, I don't think we're gonna reach the lows, right? We're gonna break the lows, right? We're gonna break the lows. Beyond the 6 months is a little bit more challenging and interesting, right? So let's assume we're gonna reach, just like value stocks, right? Value stocks this year reached pre-pandemic low, right? Spiders, because of technology, did not. So let's assume we're gonna reach at least this level, right? 340, somewhere between 340 and 320. That's the I see a strong support around this level, right? So let's assume by June we do reach this point, right? We do reach, maybe retest of the lows, another leg up, and then something like that, right? Sell in May, go away, something like that, right? We retest the lows, maybe another rally, 10-15% rally, and then another drop. What happens afterwards, right? What happens after June, right? That's much harder to predict, right? Right now, based on the data that I said, it's reasonable to assume if nothing drastically changed, passive list resistance is to the downside, right? Fed is probably not going to pivot. Next meeting is in February, right? We know that market is driven by Fed decision. So Fed probably not going to pivot before February meeting, right? Q4 earnings probably are not going to be as good as everybody expects them, right? We already have these pre-announcements from Apple, Amazon, Goldman Sachs letting go of people, Morgan Stanley letting go of people, Tesla, has inventory issues, build up of inventory and giving, extra discounts. So China has a record number of cases, COVID cases, which are probably going to take a few months to resolve. So I think it's reasonably to expect that the path of least resistance is to the downside, and we'll get to 320 level. Beyond that, there's a lot of uncertainty, right? Beyond that, a lot of uncertainty. Like nobody knows, right? It could go in any way, in any directions. So it basically has to do with your view on what Jerome Powell will do, right, between now and June, right? Again, three scenarios. If they're going to pivot, right, if they're going to pivot, let's say by June they're going to say we're going to have another 6 data points in CPI and PPI, right? So 6 more data points. Let's say they're continuously every month over month, year over year, they continue to drop, right? CPI right now is, what is it, 7? Let's say we drop to 5 or 4, right? In 7 months, maybe it's reasonable to see 5 candle. And then Powell basically indicates that Jerome Powell basically say we pivot, right? So if he says we pivot sometime between now and let's say end of summer, June, July, or at least people are going to start anticipating, then I think we're going to reach some kind of a bottom, right? And maybe strong rally, either June, July, or usually rallies are in October, right? October is very strong. Summer is very weak. October is very strong. Let's assume we're trading based on seasonality, so we're going to have this, up and down, and then, strong rally toward 2024, and we'll see. We either end slightly positive or slightly negative, right? Bull's argument, basically, we've never had 2 years in a row where the bond market gave you negative returns and equity market gave you negative returns. 2 years in a row of negative returns in the equity market, and then there was only 4 or 5 occurrences, right? Last one was in 2000, 2001. Before that, it was 74, 75. So literally every 25 years, you have 2 years of negative returns. Unemployment is low, consumers are still strong, everybody's traveling, everybody is buying, iPads and computers. So there's no reason to think that we are trading, like we had recession due to internet bubble and September 11 or energy crisis, right? So if that's not the same years, then in theory we should be positive. Okay, we're at 380, maybe we end up, maybe we can get to 400. All right, so that's, that's one scenario, right? If you're in 2 or 1, right? Obviously, if you said 2 here, right? If you said we're gonna trade in the range 2, then probably we're gonna be higher, right? Maybe 460. If you said we're not making new lows, then most likely we'll get to at least 460, 440. Right, if you said we do make lows 320 to 300, then you have different scenarios, right? This is scenario number 1, right? We're slightly up, maybe we'll get to the 410, 415 again by end of next year. That's scenario number 1. Scenario number 2, again, we trade in a range, right? By end of the year, right? And we end up somewhere between 380 and 320. Right, in scenario number 3, Fed doesn't pivot or only pivots in 24, and then we have repeat of the, of the 2000, where you have, market will bottom out somewhere in May, right? 3 years in a row of negative returns, and the bottom is found in 24, right? Maybe, I don't know, 280, 260, right? Somewhere around that level. Right, so that's scenario number 1, scenario number 2, scenario number 3 by year end, right? By year end, right? 1, 2, and 3. Right, let's try to do that. So 2024, do you think we're going to be above December high? Right, we're going to be above December high. Do you think we're going to be stuck in this range between 410? Well, it's unreasonable to think that this level will hold if we don't, trade higher. So let's say 320, right? So are we trading 1 above? Are we going to close above 410? Are we going to close between 410 and 320? Or are we going to close below 320? Below 320 by end of the year. So let's asked that question. 1, 2, and 3. Mark, 10% 1, 70%. Sound is back in, thank you. But down, thank you, down 2. 2, 2, 2. Everybody said 2, okay. Okay. Well, just mathematically, right? Just mathematically speaking, it's very unlikely that if you said 2 in the next 6 months, we're trading in a range 400 and 320, and then by the end of the year, we're trading for 320, right? We're either going to have positive news or negative news. So I think it just, there's almost zero possibility that for the next 12 months, we're going to trade between 400 and 320, right? We're either going to continue make lows, or we're going to reach the lows and start rebounding. I mean, it's right. So it's impossible, right? I mean, you can say 1, like my answer is 1 and 2, right? So, first half, my answer is, lower, right? Which would be, I forgot, I think, but, let's do it again here. So by 6 months, I think it's 3, right? Lower. I think originally I put 1, did it in reverse, but anyway. So I think it will be, H1 will be 3, right? And then end of H2, second half, I think it'll be 2. So my answer, we're going down, we reach some kind of bottom, right? I don't know where it is, depends on the news for now. If you look at our models right now, models predicting 300 actually. If you leave things the way they are and Fed doesn't pivot and things are remaining the way they've been in the past 12 months, we're heading lower. If they get worse, then we're getting much lower. But if they remain the same, then we probably with that speed, right? We went from 480 to 350, 100-point drop. At least in the next 6 months, maybe half of that. So another 50-point drop based on that speed, right? Velocity. So 380, 300, 330. That sounds reasonable. If the sell-off accelerates because worse news, we'll get to 300 to 280. If the sell-off slows down, then maybe maybe this level will hold. So my answer is 3. We're going lower, and then we're heading higher. Right? By end of the year, we might have positive returns for the next year. Not 10, 20%, but maybe flat or 2%, 5%. We'll just have to wait and see. Because I like this argument that if it never happened, then, but usually that's not the right approach, right? You shouldn't assume that if we only had 4 occurrences or 5 occurrences of negative returns, and this year it's not similar, that doesn't mean it's not going to happen. But I do agree that this doesn't look like a 2021 recession, and it doesn't look like 75, 76, energy crisis and inflation. I think we're in much better shape, right? So for that reason, I think we will get positive by end of the year. But 3 is not off the table, right? 3 is not off the table. We already hear Goldman Sachs and Morgan Stanley says that Jerome Powell will not pivot till the end of the year. So if Jerome Powell will not, if this is actually going to become true, and if inflation is persistent and the wages are persistently high and unemployment is persistently low, and your rents are double, and your food cost is double, and your energy prices is doubled. And Powell will not pivot till end of the year, then this scenario 3 is most likely to occur, right? Most likely to occur. So, and then, we do have recession similar to 2001, 2002, 2003. So that's the unknown is, when will we pivot, right? And the sooner, last 2 weeks, end of November, it looked like we're going to pivot sooner. And then next month, Jerome Powell talks, and it looks like it's longer, right? So we have this game of trying to predict what Jerome Powell will do, and he cannot predict what he will do, right? The worst case scenario is that he doesn't know what he's going to do, right? He basically says, leave me alone, let me look at the data, and every month I will tell you. So, and that's the reality, right? So the reality, we don't know, right? I'm hoping it's 2, but I do realize that it could be 3. right? And I mean, best case scenario, I do realize maybe 1, right? Maybe we have really big drop in inflation in January, February, and then JP says we pivot, and then we'll end up at 1. Right? It's possible. It's possible, but you have to make decisions and go into the next year, make proper allocations. So my proposal going into the next year is to concentrate on things that you have over control, right? If you said obviously 2, right? If you said 2, or you said we're going higher, or range bound, okay, 30% of cash is possible, right? Okay, at least 30% in cash. If you said, we're going lower, we're going to break new lows, then I propose 50% of your cash, right? You turn on TV, and there's two. It's divided into 2 camps. Some people say start buying. Some people, no, it's too early. But all of them says keep your dry powder, what's the expression? Keep your dry powder on. The point is keep your cash, right? Because nobody knows how low we're gonna get. So whether we're gonna reach 52-week low or we're gonna break 52-week low, the idea is that you need to have cash, right? So that is the most important decision. So when you trade, right? If you trade stock, that's kind of easy, right? You have, this bucket of cash, right? Or account value, right? So let's say this is cash, right? Half of your portfolio is in cash, half of your portfolio is in equity, right? Right. Most of you guys are stock traders, right? Very, less than half of your option traders. So you basically say 50% cash, right? Half of my bucket of account value is cash, 50% in equity, right? And then, if you think we're gonna break the lows, then maybe try to, buy some hedges, right? SH, right? Something inverse, PSQ, maybe this 50% of equity, you do some kind of, maybe 5% or 10% of that, depends on your views. You put SH, PSQ, maybe UUP, right? UUP is $1, right? But that's how you hedge. And 50% you keep in cash, right? Because it's almost universally accepted right now that, you should have cash, and as market drops, you use dollar cost average, right? Everybody's talking about, you turn on TV, everybody talks about dollar cost average. Right, market reaches 52-week low, you take 50% of that cash, I don't know, take third of it and you deploy, right? It drops another 10%, take another third and deploy. But always keep cash, right? Always keep cash because you need it in case market does drop below 52-week low. So that's a very important rule, cash, right? If you buy on margin, or if you buy options, right? This is equity. What if it's an options or combination of options and equity? Right, I propose the same thing, right? If you trade in, I mean, 50% cash, it doesn't matter what you trade. Bitcoin, futures, futures on futures, options on options on futures on futures. It's cash is cash, 50% in cash. Here you can say, half of my stock, half of my, 25% of my account value is in equity, 25% is in options. Okay, that's fine. I encourage you to keep options as cash secured puts, right? So if you trade in, if you have $10,000 account, right? If you have $10,000 account, only trade $100 stocks, right? And when you buy one contract, right? When you buy one contract, you basically always translate. In each contract, there's 100 shares, right? Strike price is 100, right? So I'm already trading $10,000, right? $10,000. Granted, this one contract maybe only cost you, 2.5%, $2.50, but you always, this remainder in equity, right? You always treat option as equity, right? You use either cover calls or cash secured puts, but you have cash to cover that, right? If you don't have cash to cover it, the other calculation, you basically say, okay, I don't want to risk more than 10% of this bucket. So let's say this is 25% and this is 25%, right? So I would not risk more than half of that, right? So you take this half, right? I always say 10%. when I say 10%, basically both equity and options, right? So on the $10,000 account, you never risk more than 10% of your account value, right? So we had, draws, every pullback is about 20%, right? If you go back this year, and you probably don't want to assume any other ways, right? So if you look at these pullbacks and you measure them, right? So okay, we have pullback number 1, 12% in January, okay. Then we had 17%, in March, April, and then we had 12%, and then we had 19%, and then now we are already down 8%. Let's assume it's another 15 retest or even make new lows, another 20% lows. So the point is that every time you have these drawdowns, drawdown 1, 2, we have major sell-off 1, 2, 3, we're on the 4th major sell-off, right? So imagine you're losing more than 10% on each of these sell-offs, then you're down 50%. Very hard to recover from 50%. If you're down 20% on each of these drawdowns, then you're probably not trading anymore. So going back to this diagram, right? Basically, you have to say, okay, assuming we're going to have a 20% drop down, right? So either we're going to hold the 348 and you're going to exit out your long positions, right? So at this point, you're going to be down 10% across all your positions, right? Or we drop 20%, right? You're not going to hold, you're only going to be down 5% here, right? And you basically say worst case scenario is going to be, similar, drop as we had here, right? So that's 20% drop. That's 320. So then your stop loss is here, and then, you're down 10%, right? So no matter what, you can say 2. For those of you who said 2, if the market drops at 350, you do not want to be down more than 10%. For those of you who said that lows will not hold, it will make new lows 320, then your stop loss, you don't want to be down 10%, right? So when you look at your equity, right, if you have 20% pullback in your equities, right? If 50% of your portfolio is in equity and it dropped 20%, well, that's 10% of your portfolio, right? Then you can't really have any options, right? So that is the most important calculation, right? You kind of look into the future, you have an opinion whether this level will or will not hold, and if you think this level will hold, then in case you're wrong, 10% is at the risk, right? If you don't think it's going to hold and you still want to be some bullish, some bearish position, then at this level, you do not want to be down more than 10%. That is the most important decision you can make going into the next year. How much cash you will have, how much equity you will have, how much options you will have, and make sure you're not over leveraged, right? You're not over leveraged, right? And if the market is down 10, 20%, you're not down more than 10, 20%, right? You're down less, right? But because you have hedges, if you trade in stock, consider buying SH or PSQ. If you trade in options, consider buying QQQ put spreads or Spiders put spread, right? So portfolio allocation, cash is very important. The second is number of position and position size, right? 2.5%. And especially for options trader, right? If you're a stock trader, maybe you can have a little bit more, but for options traders, you have 4 positions, you're risking 2.5%. That means in any given moment, if the market pulls back 10 to 20%, you are not down more than 10%, right? That's the goal. If you're down more than 10%, especially if you have multiple of these waves, that's when you basically stop trading. Another important concept is, we talked about ABC pattern. During sell-off, wait till end of days. That's not as important right now. Give yourself more time, right? If you think market is going to sell off in February, January, buy March contracts. If you think it's going to sell by March, buy June contracts, right? But give yourself more time when you're trading options, right? Because, and then give yourself more space, right? If you answer 2 right now on the next 6 months and you think 52-week low will hold, just assume we will make new lows. So that means you're reducing your position size. If you're going bullish and we, let's say market drops a couple percent, you say, okay, I think 52-week low will hold. Just give yourself a little bit more space. Put 5% below 52-week low, right? And then that will force you to buy less shares or less contracts. And the most important, look for signs of bottoming process or top building process, right? It was clearly, we were talking about top building process. This is an example of top building process. Week 1 ended at 400, and then week 2, 3, 4, 5, 6, we're not going anywhere, right? Same level. So as soon as we break this level, the market is in trouble, right? The market is in trouble. So look for top building or bottoming process. Same thing at some point is going to occur here. So don't assume we're going to hold this level. Look for bottom building process, right? Same thing. If you're going to see week 1, right, we reached the low, and then week 2 we're not making new lows. Week 3 we're not making new lows. Week 4, week 5 we're not making new lows, right? Except this small blip on the radar. Then this is a perfect example of the bottom building, right? Or here. Right? I mean, they go in different shapes. Lower, slightly lower highs, slightly higher highs, sometimes equal distance. But once you see that 4 or 5 weeks we're not making new lows, then this is the bottom. But, if you see a chart like this, like Tesla, right? A lot of people say, let's start buying Tesla. Well, is there any signs of bottoming process? The answer is no, right? Once you see something like this in Tesla, right? Week 1, week 2, 3, 4, 5, 6, 7, 8, 9, 10. We're not making new lows. Then you can say, okay, dollar cost average, right? I mean, it can go higher, obviously, right? Or it can go lower after this. But at least you know that this is a bottoming process, and we're probably close. We're probably close, right? So Tesla, if somebody asks me, should I buy Tesla? Yeah, if you have 3 to 5 year horizon, sure, you can start doing dollar cost average. You buy a little at 120, you buy a little at 100, you buy a little at 70. Great. This is all great dollar cost average, right? If you have 3 to 5 year horizon and you don't watch the market every week. But if you watch the market at least once a week, I suggest wait for the next 4 weeks for Tesla to stop dropping, right? Going into the earnings, and preferably after the earnings. After the earnings, we're not making new lows. Okay, I think it's time to start buying Tesla. If after earnings we are, doing this, well, then why, right? That doesn't make sense, right? So very important rule, right? Look for bottoming process. Remember that one day doesn't set the trend, right? You need 2 to 3 days to confirm the trend change, right? Spiders was a perfect example. I was watching basically a 390 level, right? The 390 level was 50% retracement from the August high to October low, right? So 390 is a 50% retracement. It traded here, it stopped at 390. That doesn't set the trend, right? You do have day 1, day 2. You want to wait at least for day 3, right? 2 to 3 days to set the trend. Once we are on day 3, we are below 390. You know that this level is broken, right? This level is broken. What used to be overhead support, now is overhead resistance. Now the market is going to have a hard time breaking through 390, right? So again, 2 to 3 days to wait for the confirmation change. Any questions on some of these rules? China needs to go higher and commodities will lead. China is an unknown, and a lot of people are bullish on China next year, waiting for the positive return. Again, I think the most common reason, right? The most common reason people basically look at China, right? They look at the weekly chart, same thing with spiders, and basically said, okay, guys, China is not going to go bankrupt, right? It dropped. China dropped 61%. I mean, yes, they have zero COVID policy. Yes, they're reopening. They're going to start spending like crazy. Time to buy. I don't know. I'm not in that camp. I think there is a downtrend. It's not going anywhere. It's building top, right? Week 1, 2, 3, 4, 5, same level. Can it break to the upside? Maybe, right? But I think the global economy has to break. But if Germany is contracting and the United States is contracting, and we are diversifying away from China, and their immunity, their herd immunity is going to take, maybe much longer to achieve than in United States or Europe, then this is not the low, right? Then we're going to make new lows, right? Even in China. So that's my opinion on China. If spiders is at 250, would you close out? What do you mean? If spiders are very far away from 250. 5 spiders 379. I mean, if spider reaches 250, would I close the position? I would close position if my portfolio is down 10%. So my goal is to make sure my portfolio doesn't drop more than 10%. Right? If my portfolio is down more than 10% at 348, I close position. If my portfolio is down more than 10% at 320, I close position. Why? Because I don't know where the bottom is, right? We agreed, right? One of the theories is that look for bottoming process, right? If you look at the monthly chart, right? If you look at the now monthly chart, right, there is really no bottom, right? I mean, we had 2 months in a row where market was in green, but that's not enough, right? And now next month is in red. So I don't see any bottoming process, right? In 2020, or when we reach this bottom and you say months 1 green candlestick, 2, 3, here you can see, okay, we've reached the bottom, right? Trend trading. So most likely this was the bottom. Obviously this was, you gave up 100% gain, but at least this is the bottom and the rally is coming and we're going to make new highs. Same thing is going to happen to spiders. 1, 2 months is not enough. You have 3 months of green stick in a row, right? Then you can say, okay, we're going to start making new highs. The next level is 550, 600, whatever. But until you have 2 green candlesticks, you don't know where the bottom is, right? I mean, it could be 350, and it could be 320, I mean, it could be 250, right? You just don't know, right? You don't know. Kevin, thank you. Gigafactory, all right. Thank you, Kevin. If you're a bear, what should you buy in addition to SH? UUP, right? I think that dollar is not down, right? And it pulled back significantly. So I think dollar is gonna go back up. Or you can buy stocks that are not correlated to the market, right? I'm not in the camp where energy is gonna be still positive returns this year, right? We had a pretty strong rally in energy, right? It ended where 65, it's at 86, 30% gain in energy names. I think we're going to have negative returns in energy next year. So I don't think you can hide in energy. Also very kind of unpopular opinion. So I would not hide in energy names, right? If you are a long-term investor, right, and you're just looking for the yield, maybe you can, then fine. And you do cover calls, then you can buy a little bit of Ford, right? You can buy a little bit of Ford. It's PE of 5 and pays 5% dividend. Maybe you can buy a little bit of Verizon, right? Kind of a blue chip dividends. You can see Verizon kind of not going anywhere. It's paying 6% dividend. Okay, so it can drop to 34. Not a big deal. You're getting your dividend. That in 3 years or 5 years from now, it will be higher. But by that token, why take a risk in 6% dividend? Where you can just buy 2-year notes for 4%, right? So you buy 4-year notes, right? You go call your broker and say, I want to start buying 2-year treasury notes. US government probably not going anywhere, and that it's a lot less risk than Verizon and Deere or even Boeing, right? So then just buy treasuries. Right? I think this will be a year of bond market, right? Municipal bonds, buy municipal bonds, buy treasury bonds, buy corporate bonds. balance sheet of most of the high grade companies is still pretty good, right? It's healthy, and we did have a pullback. In 2022, corporate bonds dropped 30%. They're probably not going to drop another 30% because there's still it doesn't look like a financial crisis in distress. Apple is still going to be here, Tesla is still going to be here, all this A and B rated companies are still going to be here, and they will pay their debt, right? They will pay their debt. So they drop 30%. I think next year they'll have positive returns. Could be large positive returns. It could close this gap, right? So I would buy LQD, I would buy UUP, I would buy treasury notes, I would buy corporate bonds, high quality corporate bonds, not junk bonds, right? I would not go into junk bonds because the theory is that this is not over, right? We're already trading in pandemic low, right? In junk bonds, and it's probably not over, right? And it's the opposite. We're probably going to have acceleration, or at least some bankruptcy, rise in bankruptcy rates in lower rated corporate bonds. Kevin, buying Tesla sooner? Okay, thank you. No. Go public has a presentation. Okay, thank you. Again, I mean, Tesla might. The point that I'm trying to make that it doesn't matter what anybody says. You kind of want to look at least a little bit at the chart, right? We didn't have very large volume, right? Still not similar volume that we had in 20s. During pandemic, right? Height of pandemic, we never had this rise. And right now, we haven't had any stabilization in Tesla, right? If you do have 3 to 5 year horizon, you want to do dollar cost average, I think, yeah, you can buy at 121 as long as, you only want to buy at 121 if it reaches 75 and you're going to buy more, or if it reaches 60, you're going to buy more. If you know you're going to, you have to know yourself, right? If you're going to buy at 120 and Tesla drops, let's say, by 50%, and you're going to sell all your Tesla position, then you shouldn't be buying it at 120, right? This is where you have to predict what you will do when the market reaches certain levels. All right. Thank you for the comments. Let's see any other questions. For new investors, when I say sell short, sell naked, not sell short. The question was about this comment. I need to change it. Don't go short. I mean, naked, sell naked options. Thank you. I need to change the slide. It should say, don't sell naked options, right? A lot of people say, sell cash secured put, sell cash secured call. I would say, especially if you don't have a large portfolio and you don't have a lot of years of experience, never sell naked. When I say go short, naked options. Renata, I don't trade leveraged ETFs, right? So if SQQ and all of these leveraged ETFs, I'd rather just buy more shares of PSQ and SH. Quit by any Duke poker player author. Quick psychology, well reviewed. Yes, I do like Annie Duke. My favorite is Thinking in Small Bets. Small. Right, so Ian just recommended, I like this book. I think every trader should read it. Really, it's like a must if you want to trade, right? So Thinking in Small Bets, very popular book. I read it. And the other one, Ian suggested Quit by Annie Duke. Quit. I didn't see. Is this a new book? Started on a new Apple product that just isn't working. Current recording helps. This is a good book. Okay, know how when to quit, right? Stop losses. Very good. Thank you for suggestion. Let me write this down so I don't forget. Okay, gotta order this book. I'll read it. 6, 7, 8, quit. Thank you for recommending it. Appreciate it. Renata, why not leveraged ETFs? Because they're repriced every day and they sell off at much faster rate than they appreciate, right? So when there's a panic sell-off, they become illiquid, they get repriced, and you can get in trouble. So for that reason, you can search, limitations of leveraged ETFs, but the idea they repriced every day, and they don't consist of the stock or ETF, they consist of options and futures. Right, they become illiquid, and when there's a panic, like in Tesla, right, it's a panic, right, just kind of in free fall, right? In what is it, 4 weeks it dropped. How much it dropped in 4 weeks? 48%, right? So when in 4 weeks something drops 40% or 50%, right, and you are using leverage ETF, it's not going to drop by 150%. It's going to drop by a lot more, or it's not going to be liquid at all, right? The liquidity will dry out. So for those reasons, I encourage you not to trade leveraged ETFs. Kevin, thank you for your comments. Thank you. All right, it's 10:34. Happy New Year. We do have different subscription levels, right? You've seen Stock Forecast Toolbox here. I've been using Stock Forecast Toolbox for finding support and resistance levels. And you can always choose any of Vlad's portfolios, right? These are portfolios that consist, elite consist of all of the portfolios, all of the subscriptions, and give you access to my trades, right? You can see my orders, you can see my positions. Right now we have some issues today, so I apologize for that, but most of the time it works, all the time it works except today. But orders, positions, and SMS message every time I trade, right? And you can follow my trades. And you can participate in morning bell and closing bell. All right, that's all I have for today. Again, happy new year, best wishes, health, happiness, and consider joining YouTube, right? On Wednesday, it's without any subscription. On Wednesday, you can join live trading room, both morning and closing bell sessions. All right, thank you very much and have a great day.